Welcome back to Digital Wealth Code, the channel where we break down how money, investing, and technology really work behind the scenes. Today, we're answering a question that investors around the world still ask themselves. What would have happened if you invested £1,000 in Tesla 10 years ago? Before we get started, a quick disclaimer. This video is for educational and entertainment purposes only and should not be considered financial advice. Investing involves risk, and past performance does not guarantee future results. Always do your own research or speak to a qualified financial professional before making any investment decisions. Now let's rewind the clock. 10 years ago, Tesla was a very different company. It wasn't a household name, it wasn't consistently profitable, and it certainly wasn't dominating the global car market. In fact, many people believed Tesla wouldn't survive long term. The company was still burning cash, production numbers were low, and electric vehicles were seen as a niche product rather than the future of transportation. At that time, Tesla's share price was around $14 per share, which, adjusted for future stock splits, meant Tesla was relatively affordable for investors willing to take a risk. £1,000 invested back then could have bought you roughly 80 to 90 shares of Tesla stock if you held onto them through subsequent stock splits. Fast forward to early 2026, and Tesla's share price is much higher than it was a decade ago. Recent market data shows Tesla shares trading around $419 to $450 per share, which converts to roughly £350 to £380 when priced in GBP terms. That means if you had £1,000 to invest in Tesla today, you could buy only about 2 to 3 shares, a dramatic difference compared with the nearly 90 shares you could have bought in 2016. For the next few years after your original investment, your decision doesn't feel particularly rewarding. Tesla's share price moves up and down with extreme volatility. Production delays dominate headlines, especially around the rollout of new models. Critics repeatedly question whether Tesla can survive without raising more money. At several points, the stock falls sharply, and many investors sell out of fear or frustration. But you stay invested. Slowly, Tesla begins to prove it can scale. Vehicle deliveries increase, revenue grows, and the company starts to establish itself as a serious player in the electric vehicle market. Brand loyalty strengthens, and Tesla's technology begins to stand out from traditional competitors. Then comes 2020. Global markets crash, fear spreads everywhere, and Tesla's stock drops sharply along with the rest of the market. Once again, it looks like the investment may have been a mistake. Instead, Tesla recovers quickly. Interest in electric vehicles accelerates, governments push cleaner energy policies, and Tesla's financial performance improves. Investor confidence grows, and the stock price rises significantly over the following years. Along the way, Tesla carries out multiple stock splits, increasing the number of shares you hold while keeping the overall value the same. These splits make the stock more accessible and attract a new wave of retail investors, adding momentum to the share price. Fast forward to today. According to widely cited financial sources and long-term market analysis, if you had invested £1,000 in Tesla roughly 10 years ago and simply held the stock, that investment would be worth around £20,000 to £25,000 today, depending on exact timing and exchange rates. That means your money would have grown roughly 20 to 25 times over a decade. Not instantly, not smoothly, and not without moments of serious doubt. There were long stretches where Tesla underperformed, where negative headlines dominated, and where selling would have felt like the sensible decision. The return didn't come from perfect timing or constant trading. It came from patience. And that's the real takeaway. Tesla's story shows that long-term investing isn't about finding guaranteed winners. It's about understanding risk, backing a long-term vision, and being willing to hold through uncertainty. Most investors don't fail because they pick the wrong companies. They fail because they give up too early. So could this happen again? Could another company today turn £1,000 into 20,000 or more over the next decade? Possibly. But it won't look obvious. It won't feel safe. And it will probably be ignored while it's happening. That's often how the best opportunities work. And that's the digital wealth code. If you enjoyed this breakdown, make sure to subscribe to Digital Wealth Code for more real investing stories, long-term case studies, and lessons that go beyond the headlines. Because the next opportunity is rarely obvious until it's already gone.